The US dollar's recent surge is reshaping global markets. Here's what you need to know. After a sharp drop ahead of the FOMC meeting, the greenback has made a dramatic comeback, fueled by a mix of economic data and shifting market sentiment. Powell's recent remarks, though not entirely dovish, marked a turning point, signaling a potential shift in how investors view the dollar's future. But here's where it gets controversial. Despite another appearance from the Fed chair at a Rhode Island conference, markets remained unchanged, suggesting they had already factored in his message. Instead, the DXY rose, hinting that traders are now searching for new catalysts. The real game changer came from two unexpected sources: today's jobless claims data and stronger than expected Q2 GDP figures. These signals reinforce the idea that the dollar's rally is more than a fleeting trend. It's a broader shift in market dynamics. The greenback climbed roughly 0.40% in a single session, reclaiming a critical level that had been holding back its momentum. Yet, some technical indicators suggest the trend might be more fragile than it seems. Will this be a temporary bounce or the start of a new bullish phase? A double bottom pattern formed right before the FOMC meeting, acting as a strong support level. But layered on top of this is a tense geopolitical environment. While no major crises have erupted, Eastern European nations continue to report Russian threats, and U.S. defense officials have called for a high-level military meeting without explanation. This uncertainty adds pressure on the dollar, as investors worry about potential political headwinds. Now, let's dive deeper into the numbers. U.S. yields have risen above 3.50%, creating a complex dynamic. Higher yields make the dollar more attractive, but the story isn't just about interest rates. Markets are also grappling with fears of persistent deficits, which could slow economic growth. That's why Fed speakers keep emphasizing their data-driven approach. This reinforces the Fed's independence, boosting dollar demand. A week after the FOMC meeting, the double bottom pattern was confirmed by strong price action. The DXY jumped 2.42% after hitting new 2025 lows, and today's 0.70% gain broke through previous highs, testing levels from August. If the dollar breaks out, it could send shockwaves through other assets. A head and shoulders pattern is emerging. Will it complete? The fundamentals seem to support this, but time will tell. Looking at the charts, prices have broken through the August downward trend, then retested it before surging higher. Mean reversion is giving the dollar a chance to rise. Traders are now watching closely to see if prices get rejected further, with consolidation near today's highs increasing the odds of an upside breakout. If this happens, the target could be 99.25, or even higher, depending on how strong the price action becomes. Positioning in the dollar is always tricky. Safe trades are essential, but the market is volatile. Follow Elier on Twitter/X for updates and insights @ElierManier. Remember, these views are the author's own and not necessarily those of Oanda or its affiliates. For more information, visit Market Pulse's Terms of Use page. Stay informed, stay prepared.